All right, this is part two of the review for cost, and this is comes from the midterm 3A that I put out in the practice exams 3 email. And so we've got here a pro forma income statement, and they are wanting to know what is the contribution margin per unit. So we've got a couple of different ways we can get to this, but I'm going to take the 1,500,000 in sales, and then I need the variable costs. So there'll be direct materials 250,000, direct labor 150,000. Oops, left out a zero. 150,000 on that one. Variable overhead of 75,000. Fixed overhead we don't need. Variable selling and general administrative is 200, and so we add that all up. We get 250,000. 150 is 400,000. 475, so that'll be 675,000. And so we take the 1,500,000 minus the 675,000, gives us 825,000. And then we divide that by the 50,000 units. And that gives us $16.50 per unit. So $16.50 there. Because what's the break-even point in units? So then I need the fixed costs. So the fixed costs are 100,000 for the fixed overhead here, and I have fixed variable and administrative 250,000. I don't see anything else that is fixed, so that's 350,000, and divide that by the 1650, so 350,000. I get 21,212, round up 21,213. Assume that for the coming year, the management of Yoni anticipates a 10% increase in the sales price, a 12% increase in variable cost, and 45% increase in fixed expenses. What would be the break-even point in the coming year? All right, so a 10% increase in the sales price, so that would take us to 1,650,000, and then the 675 times 1.12 for a 12% increase would be 756,000. And if we subtract that, we get 894,000, but we need to divide that by the 50,000 units. That will give us a contribution margin of $17.88 per unit. We then take the 350,000 fixed costs, add the 45. That'll give us 395,000, divide by 1788. Our new break even will be 22,092, 91.72, 092. So 22,000 092. All right, so that is a CVP problem. Number 12 here says Chisel Inc. currently produces 25,000 hammers per year with variable costs of 75,000 and fixed cost of 30,000 per year. The hammers sell for $5 per unit. Currently, the company has no excess capacity as is able to sell all the hammers it produces. John Maccabee, head salesman, received a special order for an additional 5,000 units at the same price. Producing the extra units will require the company to rent an additional machine for increased capacity. The cost of the increased machine is $12,500. Should the company accept the special order? All right, so what we really need to know here is what is the contribution margin per unit, and will that cover the cost of the machine, because none of the other fixed costs will go up. All right, so the variable costs are 75,000 in total, and that's for 25,000 hammers. So the variable costs are $3 a hammer. 5 is the selling price, 3 is the variable cost, so our contribution margin equals 2 on that. And so 5,000 units times 2 is $10,000. We have the 12,500 extra fixed cost. We would lose $2,500 by accepting this fix or this special order. So we should not do that special order. All right. All right, we already did this one in the last batch. This was just a repeat. Okay, this next group comes from Midterm 2B in the Practice Exam 2 email I sent out yesterday. And so we've got the Enola Company manufactures a product that sells for $400. The variable cost per unit, direct materials $100, direct labor $80, variable manufacturing overhead of $50. During the year, the budgeted fixed manufacturing overhead is estimated to be $500,000, and budgeted fixed and selling administrative is $250,000. Variable selling costs are $20 per unit. All right, so determine the break even in units. So A, first we need the contribution margin. So that will be 400 minus 100 minus 80 minus 50. All right, now most people remember the manufacturing cost, but don't forget the variable selling cost of 20 here. If it's a variable cost, it counts. So 100, 200, 250. So that means our contribution margin is $150. Our fixed costs are 500 plus 250. That's 750 divided by 750,000 divided by 150. We need to sell 5,000 units to break even. And then B says, determine the number of units that must be sold to earn 300,000 in profit before taxes. So we're going to take our 750,000 here, and we will add the 300,000 to it and divide by the 150. And so that will be 1,050,000 divided by $150. And so now we need 7,000 to get an operating profit of $300,000. Determine the number of units that must be sold to generate an after-tax profit of $90,000. So once again, we'll take the 750 fixed costs, but now we need to get we need to get the 90,000 after tax. So it's 1 minus the tax rate. All divided by 150. So the tax rate is 40%, so 0.4. So 1 minus 0.4 is 0.6. So 90,000 divided by 0.6 equals 150,000. So 750,000 plus 150,000. That's 900,000 divided by 150. We need to sell 6,000 hammers or 6,000 units on that. All right. The next one on this unit, no, we've done this one before too. I seem to like that problem. You might want to take a look at it. We did it in part 1. All right, so number 19, the Sanders Company needs 10,000 units of a certain part to use in its production. If Sanders buys the part from Rodman Company instead of making it, Sanders cannot use the excess capacity for another manufacturing activity. 40% of the overhead will continue regardless of what decision is made. The cost to buy the part from Rodman is $65 per unit. And so you take the 65, and here's the way I do it. We are told that 40% of the overhead will continue. So the overhead is $15 a unit. 40% of that would be $6. And so we're going to end up with $71 cost per unit if we buy it. On the other hand, if we make it, we have 20 plus 32 plus 15, and that would be 67. So this one's trying to trick you into thinking 67 is greater than 65, but you have to take into account the fixed overhead that's going to continue, and that's an extra $6, so it makes it not profitable. So we would be better to make the part ourselves. What will be the difference in income if they make this part? So we just take the difference here of 4, and then we take the 10,000. So our difference in income, and this is before tax, of course, difference in income will be $40,000. All right. So when we look at all this, you're going to have a high-low that you need to do. You're going to have a cost, volume, profit. So what's the break even? You're going to have a make or buy decision, and then you're going to have a production budget problem. And so we have done one of each of those, and you will see those 4 on the exam. The exam is 30 multiple choice questions, 4 problems. Multiple choice are 2 points each. The problems are 10 points each for a total of 100 points. So good luck on the exam. Feel free to contact me before you take it if you have any last minute questions, and I will get back to you. So it opens in the morning, bright and early, and so that will be Saturday morning, and then it closes Tuesday night at 11:59. So make sure you give yourself plenty of time. Good luck, and be safe, and we hope we'll be seeing you in person again soon. That's my hope, at least in the fall, for those of you who are graduating. So good luck. Bye.